Well, my next guest agrees that the Fed is behind the curve. Joining me now is Aneta Markowska. She's chief financial economist at Jefferies. Aneta, welcome. Can you respond to Jim's point here? Did corporate America show us this week that inflation is hurting a lot more than it could possibly be helping right now?
Yeah, I would agree with that. I think, the Fed obviously has pretty much locked itself into 50 basis point moves at the next two meetings. So I think the probability of them speeding that up is extremely low. And that means we won't get to a neutral rate until September at the earliest. And that just means that inflation will continue to potentially build on itself. We obviously saw a lot of cracks developing in the retail sector. So far, those cracks seem to be more in the cost structure than top line growth. The consumer actually is very resilient and is not, we're not seeing any sign of demand destruction. They're demonstrating, both ability and willingness to spend, and I think that will continue. And so the Fed is really going to have to work quite a bit harder to dampen demand and to ultimately push inflation back toward, where it needs to be.
Yeah, you think they probably will have to hike north of 4%. Is that right?
I think that's eventually where we'll have to get. I don't necessarily think the market's going to be repricing that anytime soon because there is just so much concern right now. And I think we'll need a lot of data sort of proving otherwise before investors are ready to take rates, higher from here. It might take, 3 months or even more. But at the end of the day, I just don't see how, the scenario that the Fed painted where they can slow growth just enough to push inflation back down. I think that might have been possible if they started last year when the labor market was just sort of approaching equilibrium. But we're well past that point. We already have historically tight labor market conditions and everything points to continued tightening. So, just stabilizing growth, a trend, I don't think will do it. I think they'll have to actually create slack. And typically when you start to do that, when you start to push unemployment up, that tends to create a negative feedback loop, right? Where personal income slows, that slows consumption, that ultimately slows revenues and intensifies margin compression, and that kind of leads to even more layoffs. So once you get into that negative feedback loop, it's very hard to get out of it, and you end up in a recession. I think that's a scenario that we're headed towards. It's the question of, when is that going to happen? And I'm not in a camp that we're going to be in a recession in the next 12 months. I think it's more in a 24-month time frame. But yeah, I do think that at the end of the day, the Fed is just going to have to kill this cycle.
Yeah, but it sounds like you're saying the cycle is about to commit suicide anyway.
I'm actually quite constructive on growth this year. I think we can still average 3% growth, and I think we'll slow to maybe below trend next year. But what typically, causes recessions is corporate America that's been through a long period of margin compression, that's burning cash, that's, sees its balance sheets deteriorate and ultimately shifts into cost cutting mode. And I just don't think we're quite there yet. I think that's, 20, maybe 18 to 24 months away.
A quick final question. If they did something more shock and awe style right now, raising a full point like Jim suggested, maybe doing that a few times, something truly what we would think would be almost crazy right now. But do you think that would then fix the problem? Would it basically set us up for a healthier economy in the next 5 to 10 years as a result?
I think, either way, it's going to hurt. It's a question of, do you want to take, some pain in the near term or more pain down the line? And I think, the latter scenario is more likely.
Right.
Here.
Well, institutionally, we know there will probably only be pushed to move aggressively as opposed to doing it at the moment. Aneta, we'll leave it there. And thanks again for your time today. We appreciate it.
Thanks, Kelly.
Aneta Markowska of Jefferies.